and welcome back. In this chapter, chapter 12, we'll start to talk about determining the financing mix. There is no mini exercise associated with this video, so let's get started. So to lead into this, firms need to buy assets to grow, right? Long-term assets like fixed assets, machinery, vehicles, things like that. And then also shorter-term assets, inventory, other short-term assets. And so that usually requires external financing. And so this chapter starts to get at the question, is there some best capital structure out there, right? Remember in the cost of capital chapter, the capital structure weights were the percentages of the firm's financing that came from bonds and stock, right? So is there some sort of capital structure that's best for the corporation? In other words, the one that creates the most shareholder wealth, the goal of the corporation. We'll start to look at that in this chapter. But before we focus on that, we need to understand a few different sources of risks for a firm. And let's look at those. So business risk, right, is driven by things like the stability of the economy, which is in flux right now. Maybe sensitivity to the business cycle for a firm, right? Some firms' profits are more volatile because they're more cyclical. They move more with the economy, overall economy, than others. And then maybe competitive pressures in the firm's industry are associated with business risk, okay? And then operating risk is due to cost structure. So a firm that has more fixed costs in its cost structure has more operating risk. If you think back to econ class and the simple dichotomy between fixed costs and variable costs, right? Fixed costs are always the same no matter what level of output we choose, and then variable costs scale with output. So more fixed cost means more operating risk, as we'll see in a little bit. And then financial risk, a third source of risk, comes from the firm's use of debt, right? Capital structure, how much leverage they use, right? How much borrowed money or debt. Higher leverage levels mean changes in sales have a bigger impact on changes in profitability. More leverage means more risk, which I think we understand already. So let's look at one measure of operating risk, actually. Hopefully, maybe you've seen this break-even analysis before, but if we think about these components of a firm's performance, kind of in a simplified world where we could categorize costs as just fixed or just variable, break-even analysis can be helpful. If we set EBIT, earnings before interest and taxes, equal to 0, we'll end up with the formulas on the next page, actually. We could also use something like cash flow break-even or net income break-even or something like that. But let's go with what we've got, right? And so the break-even quantity is a function of fixed cost in the numerator, and then the denominator is the price minus variable cost per unit. This term in the denominator had a special name. Maybe in another class you've heard it. It's a contribution margin. So let's do an example of finding the break-even quantity, and you'll have the formula, so hopefully the math isn't that bad. But I want you to understand break-even quantity and also break-even revenue. So let's do an example of each. So here's a fact pattern. A firm has fixed costs, $5 million, and then variable cost per unit, right, that scales with output is $75, and here's the price. So what is the break-even quantity? I've gone ahead and copied the formula from the notes, right? And so if a firm had fixed costs of $5 million, $5 million, and then divide that by the price per unit minus variable cost per unit. If you do that math, you should end up with 200,000. You can double check it. And the unit of measure is just units of output for break-even quantity. It's important to me that you understand the unit of output, the unit of measure for break-even quantity and also break-even revenue. So a firm with this cost structure would have to produce 200,000 units of output and sell them to break even, right? If they produce more than that, they'll have positive operating profit. If they produce less, they'll have negative operating profit. And then we could also characterize the break-even level in terms of sales, in terms of revenue. And the break-even revenue is just equal. There's a complicated formula in our textbook, but I feel like if we know that revenue is equal to price times quantity, here's how I do it, right? Here's the quantity, break-even quantity. Break-even revenue should just be equal to the break-even quantity times the price per unit, right? So break-even revenue for this firm should be 200,000 units of output to be produced and sold in order to break even, times a sale price of $100 per unit, right, gives us a break-even level of revenue of $20 million. So break-even quantity and break-even revenue are related. It's important to me that you understand, the different units of measure and can keep that straight. If you practice, you should be fine. So more fixed cost means more operating risk. Another measure of operating risk is operating leverage. And we don't really have we've got a formula that characterizes it. And again, more fixed cost means more operating leverage. And let's just think about how to interpret this operating leverage number the right way. So it looks kind of like a ratio. Things are characterized in terms of percent changes. So that means it's actually more like an elasticity from econ class. So let's interpret it, right? So suppose the firm has operating leverage of 4, for example, let's say that. So what does that mean in words? We could term it in terms of like the way we interpreted ratios in the past and say something like EBIT changes by 4% for every 1% change in sales. Right? You see how it kind of looks like the interpretation of a ratio? Right? The numerator changes by this much for every 1 unit change in the denominator, they're percentages. So hopefully you see that high operating leverage means more operating risk, right? So profitability in the numerator is more sensitive to changes in sales as operating leverage increases. So break-even analysis and operating leverage give us some measure of operating risk. Let's turn to financial leverage a little bit. And we saw that we already talked about how firms that have more leverage have more financial risk, right? And so when you borrow money, you have this fixed interest expense that happens whether you sell 1 million units or 0 units, right? And so the fact that we have this fixed interest payment kind of makes the good times better. If we can invest borrowed money effectively in positive NPV projects, we'll make more profits. If we can't, we'll lose even more money because the interest expense is there. So in the next video, we'll really focus more on financial leverage. In this video, we look primarily at operating risk and operating leverage, and also provided an overview of different components of risk. So in the next video, we'll continue with capital structure analysis. Thanks for tuning in.